What's up, my fellow iguanas? Iggy here with some exciting news that could mean big profits for savvy investors. In this video, I'll break down how falling yields are creating a potential goldmine for Singapore's real estate and stock markets. You'll learn all about SREITs, those income-generating property giants, and how they could be poised for a major rebound. Plus, I'll share insider tips on how you can cash in on this opportunity. Get ready to unlock the secrets of the investing world, iguana style. SREITs, or Singapore Real Estate Investment Trusts, are investment vehicles that allow investors to pool their money together to purchase and manage a portfolio of income-generating real estate assets. These can include shopping malls, office buildings, industrial properties, hotels, and even hospitals or serviced residences. By investing in an SREITs, you essentially become a part owner of these properties without having to directly purchase or manage the real estate yourself. The key advantage of SREITs is that they provide investors with exposure to the real estate market and a steady stream of rental income from the properties in their portfolio. Unlike owning physical property, SREITs offer liquidity as their units are publicly traded on the Singapore Exchange, allowing investors to easily buy and sell their shares. SREITs are required to distribute at least 90% of their taxable income to unit holders in the form of dividends, making them an attractive option for investors seeking regular income streams. Additionally, SREITs benefit from tax transparency, meaning that they do not pay corporate income tax as long as they distribute the required portion of their income to unit holders. Now, the Singapore Exchange, or SGX, is our local stock market where companies like these SREITs are listed and traded. Having a strong and vibrant SGX is crucial for attracting both local and foreign investors to Singapore, fostering a healthy investment environment in our country. This, in turn, provides more funding opportunities for companies to grow and expand their businesses. So, what's the big news that could potentially give a boost to the SGX and SREITs? Well, it all comes down to something called risk-free rates. These are the interest rates on super-safe investments like U.S. government bonds, which are considered virtually risk-free because the U.S. government has an extremely low risk of defaulting on its debt. And recently, these risk-free rates have been dropping like a rock, meaning the returns on these safe investments are getting lower and lower. When risk-free rates decline, it makes riskier investments like stocks and real estate look more attractive in comparison, as investors seek higher returns elsewhere. This is because the lower the risk-free rate, the less compensation investors require for taking on additional risk. As a result, money tends to flow out of safe investments and into riskier assets like stocks and property when risk-free rates fall, driving up their prices and valuations. Let me give you an example to help you understand how falling risk-free rates can make SREITs and the stock market more attractive. Imagine you're a real estate investor looking to buy an apartment building. If the interest rates on super-safe investments like government bonds are high, you might hesitate to invest in that property. Why? Because you could earn a decent return just by parking your money in those low-risk bonds without any hassle. However, when those risk-free rates start dropping, the game changes. Suddenly, investing in income-generating properties like the ones owned by SREITs becomes way more appealing. Think about it. If you can earn a higher return by collecting rent from tenants than you would from those low-yielding bonds, it makes more sense to put your money into real estate. That's why falling risk-free rates can be a massive tailwind for SREITs, driving up demand and potentially increasing their valuations. The same logic applies to the stock market as a whole. When risk-free rates are low, investors start looking for higher returns elsewhere. Stocks and other riskier investments become more attractive because the potential rewards outweigh the low returns from bonds or savings accounts. So, lower risk-free rates can be a boon for the entire stock market, including the Singapore Exchange, SGX, where many of these companies are listed and traded. Now, let's dive into the juicy details that could really shake things up for SREITs and the SGX. The 10-year US Treasury yield, which is a key benchmark for risk-free rates, has dropped to around 4.29%. That's a pretty significant drop, but here's where it gets even more interesting. Analysts are predicting that this yield could fall even further, potentially hitting the 4.2% range. If that happens, it could create a massive tailwind for SREITs and the Singapore Stock Exchange. Think about it this way: when risk-free rates are high, investors might be tempted to park their money in those safe investments and earn a decent return without taking on much risk. But when those rates start to drop, suddenly income-generating properties like the ones owned by SREITs become a lot more attractive. Investors start to look for higher returns elsewhere, and that's where SREITs can really shine. But wait, there's more good news on the horizon. The European Central Bank is about to move into a fancy new building owned by CapitaLand Integrated Commercial Trust, which is one of Singapore's largest and most prominent SREITs. And the rumor mill is buzzing with whispers that the ECB might start cutting interest rates soon. If that happens, it could provide an additional boost to SREITs like CapitaLand, as lower rates typically make real estate investments even more appealing. Now, I know what you're thinking: Iggy, this all sounds great, but how do I actually make money from this? Well, my scaly friends, there are a few options to consider. The most straightforward way is to invest directly in SREITs through the stock market. These are companies that own and manage income-generating properties like shopping malls, office buildings, and industrial parks. By investing in their stocks, you essentially become a part owner of these properties and earn a share of the rental income they generate. Some of the bigger players in the SREITs space include CapitaLand Integrated Commercial Trust, which owns iconic properties like Plaza Singapura and Capita Green. Another major player is Ascenda's Real Estate Investment Trust, which focuses on industrial properties and logistics facilities. Mapletree Industrial Trust is also a prominent name, with a portfolio of flatted factories and high-tech buildings. Another great way to get in on the SREITs action is through exchange-traded funds, or ETFs for short. These nifty investment vehicles allow you to buy a single fund that holds a diversified basket of SREITs, rather than having to pick and choose individual stocks. It's like getting a whole buffet of real estate goodness on your plate with just one scoop. The key benefit here is diversification. By spreading your investment across multiple SREITs, you reduce your overall risk compared to betting the farm on just one or two companies. And let's be real, even the most seasoned investors can have trouble consistently picking winners in the stock market rodeo. With an SREITs ETF, you get that sweet diversification without the headache of researching and monitoring a bunch of individual REITs. Plus, these ETFs tend to have relatively low fees, making them a cost-effective way to gain exposure to the SREITs market. It's like having your very own real estate portfolio manager working for you at a fraction of the price. And finally, if you're feeling really bullish on the SGX itself, you could consider investing in the stock exchange operator, Singapore Exchange Limited. This company operates the Securities and Derivatives Exchange in Singapore, facilitating trading and providing services to support the ecosystem. By investing in SGX, you're essentially betting on the continued growth and success of Singapore's financial markets. However, it's crucial to understand that investing in any asset class, whether it's SREITs, stocks, or even the exchange itself, carries inherent risks. The markets can be volatile, and there's no guarantee that the favorable conditions we discussed will play out as expected. Economic factors, geopolitical events, and unforeseen circumstances can all impact the performance of your investments. That being said, for those willing to take on a calculated level of risk, the potential rewards could be substantial. SREITs, with their income-generating properties and potential for capital appreciation, offer an attractive opportunity. The stock market, while volatile in the short term, has historically provided solid returns for patient, long-term investors. And investing in the exchange operator itself could be a way to participate in the growth of Singapore's financial sector. Ultimately, the key is to do your due diligence, understand the risks involved, and invest within your risk tolerance. Diversification is also crucial, as it helps mitigate the impact of any single investment on your overall portfolio. With careful research, a disciplined approach, and a long-term perspective, you can potentially capitalize on these opportunities and work towards achieving your financial goals. There you have it, my scaly friends, the inside scoop on how falling yields could spell a massive comeback for SREITs and the SGX. Whether you choose to invest directly in these real estate titans, go for a diversified ETF, or bet big on the exchange itself, the potential rewards are tantalizing. But as always, do your homework and invest wisely. If you found this video insightful, show some love by smashing that like button. And if you haven't already, hit subscribe so you never miss out on Iggy's latest investing adventures. I'll keep bringing you the hottest tips and tricks to grow your wealth and achieve financial freedom, iguana style. Until next time, stay green and keep that money tree growing, my friends.